Right, thanks Chelsea, and welcome everyone who's in person and also who's online. So tonight's topic is the 2022 budget. We're also going to talk about tax planning, and then we're also going to talk briefly about the family trust potential rule changes that were announced a few weeks ago. So there's a bit to cover. I'm going to go relatively quickly, which I do generally anyway. But yes, as Chelsea said, there'll be questions at the end. So keep them for then, or if you want to put them in the chat, please do so. So let's get started. Got to do this every time. So the general disclaimer, this is general advice only. It may not be relevant to your particular circumstances, so take that in the context. If you need any further advice about your particular circumstance, then please come and talk to Aintree Group or your advisor. So yeah, this is general in nature. So part one, the federal budget. So it was handed down last week. Josh Frydenberg's fourth, I think, from memory. And it's a pre-election budget. So I've got a little infographic here which talks about the key things that were announced, and I'm just going to move out of the way a little bit. Sorry if I keep going backwards and forwards. Yeah, I'm getting in the way. So the key things which probably people are aware of, some of these already. So the excise, so reduction in the fuel excise, and you've probably seen that at the bows already. So that's come through. There's a cost of living offset we'll talk about. There's $1 billion put towards small business going digital, which I'll cover as well. There's cost of living payments, which I'm not going to talk about tonight, but basically a one-off payment to pensioners and low-income earners. Also changes to superannuation minimum drawdown, which I'll cover. Employee share scheme changes. STP, now that's single touch payroll, that's to do with processing wages through your accounting system. We're going to cover that briefly. Some training bonuses and some money for apprenticeships. So they're the key things that we see out of the budget. The deficit is estimated to be 78 billion for the next 12 months, so quite substantial, falling to 43.1 billion in 25-26. So it's going to be in deficit for the foreseeable future. I'm not going to make commentary on whether that's ever going to get into surplus or not, but it's got a long way to go to get there. So it's all about revenue and expenses, obviously, to try and balance the books. So first one, cost of living offset. So this is one that's been in place for a couple of years now, and this is for the current financial year. So at the moment it's $1,050, $1,080, and they're going to increase that to $1,500 for the current financial year. So what that means is that depending on what your income level is, this is the offset and how it works. So the minimum offset is if you're earning $37,000 or less, you get a $675 offset. If your taxable income is between $90,000 and $126,000, you'll get the maximum amount you can get is $1,500 for $90,000, and then there's a phasing in or a reduction in that based on your income being above $90,000. But that you only get that when you lodge your tax return. So it's not something that the government's going to give you until you lodge your tax return. So it might be an incentive for people to lodge their tax return if they're going to fit into this criteria. That's for this year only, and then it's gone, no more. So unless the government announces a further rebate like this in future years, but this is the last year that's on the table based on legislation. Minimum super drawdown. So if you're in a pension phase in your superannuation fund, whether it's a self-managed super fund or whether it's an industry fund or a retail fund, when you reach retirement age and you're required to withdraw from your super fund, you've got a minimum amount. And these are the rates that are normally apply. There it is, these ones here. But the government has extended the concession that's been going for 2 years, and they've extended it for another year, whereby they're halving the amount of the minimum drawdown. So if you're on the 75 to 79 bracket, it's only 6% of the value of your pension account that you need to withdraw. They're reducing that to 3%, or they've reduced it and they're going to extend it out to 30 June 2023. So what that means is there's more money left in superannuation environment, which can have some tax benefits as well. But that's an important one. Key thing with pension drawdowns is you must make that every year. If you don't meet the minimum requirement in a year, then that has some adverse tax consequences for you. With our clients and their self-managed super funds, we send a letter out to the clients every year. We're going to do that for our clients in the next couple of months before 30 June, just to remind them that if they haven't done it already, they need to withdraw that money to make sure they get their pension account concessionally taxed. That tax rate is 0% on the earnings if it's in pension account. If you don't do that minimum withdrawal, then it has to revert back to accumulation, which is taxed at 15%. So it has an impact on your balance if you don't do it properly. So that's minimum drawdown super. Reduction in the fuel excise. So this is the one you see, when you go to the petrol bowser. So, we've seen prices at $2.20, those sort of figures. So they've announced a 6-month reduction in the excise of 22 cents, roughly 22.1 cents, and that's brought the price down. That's flowing through now into petrol prices. I think now I've seen today there was down to 169. I think I saw somewhere. That's a product of both this and also oil prices internationally actually have come down a bit because the US government's released a substantial amount of additional oil into the market. But that is a 6 months temporary relief. So in September, it will go back to the original amount, and depending on who gets into government at the next election, if Labor gets in, they've said already that they're only going to allow this to go for that 6 months, and then it's going to revert back to the higher price. So it looks like that's just a short-term benefit. That's not going to be long-term. But interesting how they collect, how much they collect on fuel excise per litre. So 22.1 cents is a lot. 44.2 is a substantial amount that we have to pay. That normally gets indexed each year as well, just to let you know. And so it's progressively growing. But anyway, make sure you fill up your petrol tank before the 28th, just on the 28th of September, before that price goes back up. Because I'm sure the petrol companies are going to put it up straight away. I don't think they're going to delay it for any reason. So, yeah, look out for that. This one's an interesting one. So lower tax instalments for small business. So a lot of people are aware of what's called the PAYG instalment system, the pay-as-you-go system, whereby based on the prior year's tax return, the tax office says, okay, we estimate that your tax for this year, for the current financial year, is based on the same as the previous year. What they normally do is they normally uplift that tax from last year. So let's give you an example. Let's say you had a tax liability in your business of $20,000 last year. When they do the assessment of how much you should pay in quarterly instalments, they basically index that or increase it by 10%. So they'll say, okay, we estimate that you're going to pay $22,000 in tax this year. So therefore, we want 1/4 of that every quarter. So 5,500. So what they've said, instead of uplifting it by 10%, they're only going to uplift it by 2%. So instead of it going up to 22,000, it's going to go to 20,400. So therefore, the instalments per quarter are going to be less. Therefore, you're going to pay less per quarter along the way. Bearing in mind, though, that year end, there's a reconciliation that's done. And if your tax is higher than what that estimated tax is, you're still got to pay that amount. So it's just deferring the inevitable for some clients. For those who are on a ultimate lower tax rate than what this is, that means they're going to get a refund at the end of the year. But it's just really important for clients to always monitor your profitability of your business every quarter to ensure that those tax instalments that the ATO has advised you based on this calculation are adequate for you or appropriate for you. If they're not, you've got the ability to vary those instalments anyway. So you can say, okay, my profit is not going to be where it's estimated to be. So instead of me paying that $5,200 instalment or whatever it might be, do some calculations, get your account to help you, and then say, okay, look, I think the tax should only be $4,000. You can go and advise the ATO that you want a variation and therefore reduce your tax instalment to that figure that you estimate. The key warning with that is that if you underestimate by 15%, penalties can apply. So you can't just say, okay, I can't afford to pay or I don't want to pay, so I'm going to vary it to zero. That doesn't work. The ATO will actually penalise you for underestimating. One thing, just to be cheeky on this one, that 10%, or that they've applied, they haven't applied that for 2 years anyway because of COVID. They've just been using the same amount as previous years anyway. So it all sounds lovely that they're not going to increase it by 10% this year, but they haven't been doing that anyway for the last 2 years. So the 2% means it's going to go up based on what it has been now anyway. So a bit of smoke and mirrors on this one. But yeah, that's something to be aware of. And it applies to both GST and also PAYG instalments. So for 10 million aggregate turnover for GST and 50 million turnover for PAYG. I should be careful about all the commentary I make with these things, but why can't they make them consistent just to make it easier for people? It just makes it difficult to try and manage. Consistency would be really good in these things. Okay, next one, small business incentive. This is for the digital expenses, so tax deduction. Now, this is another interesting one. So what they're saying is that if you spend money on making your business more digital, so cloud-based computing, et cetera, they're going to give you an additional deduction. So if you spend $100, they're going to give you a tax deduction for $120. And they're going to allow that for up to $100,000 worth of expenditure per year. Now, this has been announced, and it says it applies from the 29th of March, which is when budget was handed down at 7:30. We don't have any legislation. We don't have detail about what it actually is allowable and what's not, what's covered under this arrangement. So it makes it really hard to plan. So we can't categorically tell you, yes, go and do that, and then you're going to get 120% tax deduction for it because we don't know what the detail is. There's only 2 more sitting days of Parliament, And this legislation is not planned for those 2 sitting days before the next election. So this is one you've just got to be very careful of, because while it's a good incentive, the devil's in the detail. We don't know what the detail is. The other thing too, again, and I'm back to that thing about, making things practical and easy. It says that any expenditure incurred up to 30 June 2022, you can't claim it in the 2022 tax year. You have to wait until the 2023 year and including the 2023 tax return. So administration-wise, we've got it as your advisor, we've got to then look at what the expenditure was up to 30 June 2022. We've then got to keep a file note and then remember to put that in the tax return for the next year, because you can't claim it until the 2023 financial year. I won't say any more. Key thing at the end is don't do things just to get a tax deduction. So while this is a nice little incentive, we don't know the detail, and 2, you don't just spend money to get a tax deduction, because even at 120% tax deduction, you're still out of pocket, because you only get back, if you're a business, 25% company tax rate maybe, or 30%. You're still going to be out of pocket by doing so. Don't just spend money for the sake of getting a deduction. It doesn't make sense. So just be very cautious of this one. We're hoping there'll be further detail released soon, just to give us parameters about what might be included in it. And then we've got to wait to see if the legislation comes through before the election. And then if there's a change in government, we then have to hope that if the new government comes in, they'll honour this deduction. So it's hard to advise on what the right thing to do is, but it's been announced. Then the same applies for this one, the training incentive. So again, from the 7:30 on the 29th of March, there's a 120% tax deduction for training courses. Again, we don't know what training courses are included. They've given some scope on that, because they've said that you need to have turnover less than 50 million. That applies to both of these deductions as well. External training course provided to employees in Australia or online and delivered by entity registered in Australia. So that's one key thing you've got to look at. And it says some exclusions will apply, such as in-house training and so on. So again, we don't know all the detail, because these are just statements without actually having the detail behind them. And again, the same thing applies. You cannot claim them in the 2022 tax return. You have to wait till the 2023 tax return and then claim them in the 2023 tax return. So to spend the money now, you could potentially, if you don't lodge your tax return until 6 months after the end of the 2023 financial year, you could be waiting 20 months or so before you can actually get the benefit of that expenditure. So again, don't do it just for a tax deduction. Make sure it's part of what you think is necessary in terms of the training, and then make sure that it qualifies, and that's the tricky part that we just don't know yet. Employee share schemes. So this is something becoming more popular in Australia. It's very common in overseas, particularly the US, employee share schemes. In Australia, it's becoming more popular. And what they're doing is they're relaxing the rules. I'm not going to go into too much detail on this one because it's quite technical, but what they're doing is they're allowing more flexibility in terms of you offering shares to your employees, and they're increasing the thresholds where tax consequences don't apply or do apply. So as I said, I'm not going to go into it, but basically they've increased some thresholds, and there's some really, like you read this part of it, and this is taken straight off some literature we got from the government. Try and tell me how you understand that. Doesn't make much sense to me.
For those who are watching online, he's referencing where it says
30,000
per year.
Per participant per year. So that, again, we need to see the detail on how that works. And also it's got to pass Parliament as well. But key thing is, normally when you issue shares to an employee at a discount, there's tax consequences. This provides some relief from those tax consequences, but these are always tricky things to do, and they require a lot of documentation, require legal input as well. But they're relaxing the rules, which is a good thing, and will incentivise employees to be part of their businesses, which is be a good thing, I think. COVID-19 tax deduction, so another one that's been reaffirmed in the budget, and from 1 July 2021. So it basically means that expenses incurred by individuals for COVID tests, so RATs and PCRs, will be tax deductible, and there's also some relief from capital gains, from FBT in that respect as well. So employers get some relief if they're providing RATs and other COVID-related expenses for their employees. And then secondly, with that too, there's also been a lot of government payments from Victorian government and other state governments, and there's a lot of exempt income that has been received. So there's $10,000 grants that have been coming through and other things over the last 18 months or so. From July 2021, they have been tax-free. so you don't have to pay tax on them. So, but yeah, again, any more detail you need on these things, talk to your accountant and they can go through it with you. So digital reporting updates. So again, look at the dates on this, 2024. So it's 2 and a bit years away. So great announcement, but I don't know what's going to benefit at the moment, but anyway, we're getting there. What this is in essence is doing, they're basically through single touch payroll, which is the main mechanism for paying wages now. All entities should be on single touch payroll now. That provides instant data to the ATO regarding people's wages and so on. So for instance, Peter, as an example, if you want to see what your wage was at the moment from your employer, you could go onto your MyGov account, click on a link, and you'll be able to see exactly what your year-to-date salary is from your employer, plus how much superannuation they've paid on your behalf. So all the details about your employment with that employer, plus any other employees you've had during the year, and also for the last 2 years. So what they're doing is they're embracing that technology and going a bit further with this, and actually going to start sharing information between government authorities. So at the moment, that single touch payroll data stays with the ATO. But what they're going to start doing is they're going to start using the reporting systems to actually send information to the state and territory payroll tax officers, so it can help them reconcile payroll tax work cover. It's all about helping business reconcile their information. Don't be cynical. It's about helping businesses. It's not about knowing too much about or knowing more information about your business to make sure you're complying. It's about helping businesses reduce the red tape that they of their compliance requirements. So it does make sense from a red tape point of view. It will free up some compliance, but on the flip side, yes, you can't hide. Simple as that. So, so they're investing a lot of money, but most of it will come in from the July 2024, but this one will come in 1st of January. Again, I'm not going to go into this, but single touch payroll is a source of this. What they're also using single touch payroll for is to work out whether there's unpaid superannuation, and they're having a lot of success, the ATO, in tracking down businesses that aren't paying their superannuation. And so that's something else to be aware of. When I talk to clients about if they're in a cash flow situation where they're struggling a bit with their cash flow and meeting their tax obligations, the first one they should be looking at paying is superannuation, because that one has the biggest consequence if they get audited, because there's substantial penalties that go with that. So, but yeah, it's the other part of this that's coming too. Whoops, I've gone too quick. There's also e-invoicing, which is coming. And what e-invoicing will do, it will actually, again, if for instance you've got a Xero file or an MYB file or whatever it might be, you can send an invoice electronically. You don't have to actually email that to the customer. They'll actually get it straight into their system based on the e-invoicing, or going straight into their draft invoices that they've received as something they need to pay. So they don't actually need to physically receive an email for that invoice. What that's also going to do, and this has been happening in the UK for quite a long time, that e-invoicing, the government gets that data as well. And then when it comes to doing their GST return, their VAT return in the UK, and this is what will come in Australia as well, it's already got your populated income. They already know what your income is, because the e-invoicing actually shows what your income is for the quarter. So then they'll populate that in your BAS. Again, nowhere to hide. So they'll have that information easily. So that's something that's coming to Australia over time, but this is the first part of it. I think it's probably a number of years project, but this is the first part of that income data sharing and the ATO being aware of what your income is. They're probably the main ones from the budget that I want to talk about. There wasn't really much else in it, to be honest, except for the cash handouts that were being offered and so on. And so, you know, there's not much to talk about. So I'm going to go into tax planning in a minute. The key thing with this is that because we've got an election coming up, it's about whether these things get through or not. We just don't know. So it comes down to whether there's a change in government or not, and then whether they can get this through the Parliament if they do retain government. Again, I'm not going to comment on which way that's going to go, but just got to be mindful that there could be a change, and therefore some of these things may not apply. So the best thing to do is talk to your accountant, your advisor, and they can give you their further input into it, so you can make proper decisions or informed decisions as much as you can based on the information that we have at hand. So that's it for the budget. Now let's talk about some tax planning. Just check one, see how we're going. Okay. Tax planning, just a quick summary, pretty basic stuff. This is what the current tax rates are for they're the same as what they were last year. So 2022 and 2023, these are the individual tax rates. Top margin rate kicks in at 180,000 and you pay 45% tax on the amount above 180,000, and that's the tax you've made towards that up to the 180. So Those rates haven't changed for a couple of years. There is proposals to change these down the track. Again, it's all subject to legislation, whether it gets through or not. So I'm just going to stick to what we know, but that's what it is. Now, obviously, the first 18,200 is tax-free. There are some small business rebate, so low-income rebates you can get. That 1,500 one I talked about before, that can actually mean you can earn more than that and still not pay tax. But that's the starting point for tax-free. And then we've got this tax bracket here. These figures don't include Medicare though, so another 2% on top of that for Medicare. Right. Great. So the standard rate for companies is 30%, unless you're deemed to be a small business or a base rate entity where the tax rate is 25%, and that's for businesses generally with a turnover of less than 50 million. And so again, just from a tax planning point of view, we've got some clients at the moment where we're right on the cusp of that 50 million, and the impact of being 25% or 30% is quite dramatic. So if they earn 50 million and $1, they've instantly got a 5% increase in tax rate over the total of their income. So it has a really big impact. So it requires a bit of planning if you're close to that threshold. But yeah, basically under that threshold, 25%, over that threshold, 30%. There are some exceptions, but that's technical and I'm not going to go into it today. Superannuation. Okay, so if you're in accumulation phase of your super fund, then the tax rate is 15%. However, if you have taxable income personally that's over $250,000 personally, and you make contributions into super, or your employer makes contributions into your super, then the contributions can be taxed at a maximum rate of 30%. So there's an additional tax of 15%, which is under Division 293 of the Tax Act. It says that if your income is over $250,000, then those contributions are going to funds, which are normally taxed at 15%. There'll be an additional tax rate up to a maximum of 30%. There's a shading, you've got to do some calculations, but yeah, it's between those two bands. But when you're in accumulation phase, it's normally 15% on the earnings. So if the super fund gets dividends or interest income or anything like that, it's taxed at 15%. If you're in pension phase, the pension component, which I talked about before, is taxed at 0%. Yes, yeah, some relief, yes, but that's to a maximum. The cap on that is 1.6 or now 1.7 million, and I'll talk about that in a couple of minutes. So strategies, and these are bog standard strategies we do every year. There's nothing new in any of this. So key things are subject to cash flow requirements. If you can legitimately, you've got to be careful. Don't just defer invoices because you want to, but if you can defer income from one year to the next, then you'll get a deferral of tax. So I'll give you an example. If you've got an invoice that's on 30 June this year, then it's in this financial year. Therefore, you pay tax on your tax rate at 25% this year, if that's the applicable rate. If it's on the 1st of July next year, you've got another 12 months before you have to declare that and therefore pay tax on that. So if you can legitimately defer income, then that's what you should do. You just be careful you're not just doing it by, changing the date on an invoice. Don't do that. But if you can legitimately defer invoicing, then that gives you a deferral and therefore a cash flow benefit. With deductions, so just on that too, yeah, and then also it comes down to whether you're on what's called an accruals basis or a cash basis for accounting. So generally when you raise an invoice, that's the date when you declare the income for tax purposes, but some businesses can do it on a cash basis, which means they only pay the tax on the income when it's received. Right, so it's about getting advice from your accountant about which method you are adopting to then dictate what strategy you can put in place regarding deferral of income. Ensure that you meet all the requirements for claiming tax deductions. Simple thing is make sure you've got a receipt. A lot of people don't. They think the credit card statement cuts it. So if you've got an expense and you don't keep the receipt and the ATO audits you, if you can't show that receipt, they'll deny the deduction. Right? It's a pain, but make sure your record keeping's up to scratch, that you've got the documentary requirements to claim that tax deduction. As I said, credit card statements, don't cut it. There's a couple, I think Amex has one where it actually does give you tax invoice details on it and so on. You might be able to, but generally it's having that receipt and storing that for a period of 5 years. You must keep it. Make sure you've got those receipts. Bad debts, if you've got any bad debts, and hopefully you don't, but in this climate, there might be some, you've got to make sure that they're written off before 30 June. Right, so it's not just a matter of saying, looking at my debtor book and saying, okay, oh, that one's a bit old. Yeah, I'm going to say that's a bad debt. You need to physically remove it from your debtor system, and you need to show evidence that you've taken all steps to try and recover that debt. So you can't just pick that one to be written off just because it suits you for tax purposes. Right. So again, if you get audited, the auditors, the ATO will want to see evidence that you've taken all the steps to try and recover that debt. So put it through a debt collector or whatever else, show correspondence of you trying to recover that debt. And then you need to, if you're a director of that company, you should do a resolution at year end saying we've done all the steps necessary to try and recover the debt, but we cannot. So we've made a determination to write it off. Right. So it's really important you have the right documentary evidence for writing off bad debts. Superannuation. Now, this is a really important one. So obviously, superannuation, you've got to contribute on behalf of your employees, and you do that every quarter. So the minimum requirements are you must pay money into superannuation 28 days after the end of each quarter for your employees. And if you don't do that, you lose the tax deduction. So you actually can't claim a tax deduction if you're more than 28 days after the end of the quarter before you pay that into their super fund. The other part of it is really critical that a lot of people don't understand is that it must be received by the fund. So it's not about you doing the transfer on the 28th day of October as an example, or a good example now is April. If you make the payment on the 28th of April, if it's not received by the employee's fund by the 28th of April, it's still not tax deductible and you've not met your obligation. So we always say you should pay it at least 2 or 3 days before the due date to ensure that it's been received by the employee's superannuation fund. When it gets to 30 June, if you don't pay it by 30 June, you don't get the tax deduction. You only get it when it's paid. So this is a different one to where it's an invoice where you claim a deduction on an invoice. With superannuation, it's only deductible when it's paid and received by the fund. So if you want to get a tax deduction in the 2022 financial year, so by 30 June this year, it has to be paid before 30 June. And because there's a mad rush that goes on at 30 June to try and pay superannuation before that due date, a lot of the clearinghouses or software providers say you've got to pay it 10 business days before for them to guarantee that it's going to be received by the fund by 30 June. So don't leave it any later till about the 20th of June if you want to get a tax deduction this year for your superannuation deduction for your employees or for your own deduction. So if you're making a contribution yourself into the fund, it's got to be received by the fund. So don't leave it too late because you might miss out on the deduction because of the volume of transactions that need to be processed towards 30 June. So it's really important you plan for this one if you want to get that tax deduction this year. The other one, which a lot of people don't understand too, is depreciation. So you might say, oh, look, at the moment and I'll cover this in a minute about write-offs, I want to buy a new car and therefore I want to get a tax deduction this year. You can't get that tax deduction until you've physically got the car and it's ready for use. Or same with that machinery. If you're buying I'm trying to think what it could be, some sort of machinery for your business, you need to have that installed, ready for use in order to claim the tax deduction. It's not just getting an invoice. The invoice doesn't cut it as being the basis of claiming that tax deduction. It must be physically on hand and ready for use in your business. At the moment, it's hard to get a car. Miles, you could probably jump in on this one and vouch for that because you do a lot of finance for cars and so on. Yeah, you might have 3-6 month wait. So if you're planning on buying a car before 30 and you get a benefit of a tax deduction, you're probably leaving it too late based on the supply issues that are going on at the moment. And similarly with other machinery and things too. There's just, the supply chains at the moment are really struggling to meet demand. And therefore you can't rely on, if you order something now, getting that before 30 June to get that tax deduction. If it arrives in July, then you have to wait another 12 months to get that tax deduction. All right, so it's really important you're aware of that. It's got to be installed, ready for use. Business income expenses. So this is where, again, we've got all these different thresholds. We talked before about a $50 million threshold. We've now got a $10 million threshold for other deductions. Again, it'd be lovely if they could make all this consistent. So not trying to work out, okay, does 10 million apply on this one? Does 20 million apply? Does 50 million apply? Whatever the figure is. But basically, small businesses with turnover less than 10 mil can claim expenses for prepayments. So you might get towards 30 June and think, look, I've had a really good year this year. What can I do to reduce my tax this year? Oh, I might prepay my rent for 6 months or 12 months. If you do that before 30 June and you physically pay that before 30 June, provided the term of that prepayment is no more than 12 months, you'll get a tax deduction for that in the current year. So that can be a good tax strategy, provided you've got the cash to be able to do it. So that's the other important thing with this. But it's a good strategy where you can bring forward expenses to claim a tax deduction for them. It can be rent, it could be subscriptions, it could be insurances, it could be all different things that are business related. But it's a real opportunity if you've had a good year this year and you've got a bit of cash that you can pay to bring expenses forward, then that's a good opportunity for you. For anything that's over $1,000, anything under $1,000 is fully deductible anyway. You don't need to worry about the timeframes on it. But those things are more than $1,000. If you prepay, then you can claim a tax deduction for them. Wages to family and spouse. So that's another one where, making sure you remunerate your family if they're working in the business. You've got to make sure it's justifiable, but that's another opportunity where you can get some benefits. I'm not going to say, I shouldn't say the word income splitting, but if they're generally doing work for the business and they're on a lower tax rate and you can remunerate them, then that can be a tax advantage for you. So major purchases, which I talked about before, capital equipment. Again, make sure that you qualify and it's got to be installed ready for use before 30 June to get the benefits. Bit of housekeeping. If you've got assets, you know, you've got a laptop that's no longer working, it's still on your asset register and it's still got value, write it off. If it's scrapped and it's got no value, get rid of it, throw it out, and then claim that tax deduction for the balance of the depreciation left on that asset. So it's always good housekeeping. We always encourage our clients to do this. Go through your asset register to see what's still there, what's not. Anything that's no longer existing because you're throwing it out because it's no longer working or you've sold it, then we should be cleaning that up in the asset register. And if there's any excess depreciation left over, then you want to claim that in your tax return. Revalue trading stock. So with trading stock, you might, and again, this is an issue about perishables particularly, but other things that might reduce in value or become obsolete over time. Best practice is to value stock at lower of cost or market selling value. So let's say you bought, you're a retailer and you sell TVs, and you bought this Samsung TV, a whole bunch of these Samsung TVs, and your cost was $2,000. But now the new models come out, and now those ones you've got in stock still, and now you can only sell them for $1,500. You should be marking those down to whatever, if the market value is less than the cost, you should be writing them down to the market value, and then you'll get a tax benefit for that. So just always review your stock levels. Also, just a good idea to make sure you're on top of your stock level and you're cleaning those up and you're not carrying old stock anyway. Try and move that, get the cash flow in, and get that off your books as well. And some of these things are really important. So it's about looking at what your income is for the current financial year. So having up-to-date books and records so you know where your position is in terms of its income and tax. And then also looking at the forecast or predicting where you're going to be next year. Because again, if you think you can have a good year next year or a bad year next year, you can then look at whether you defer income, bring forward expenses, or other to try and get trying to get the spread between the 2 years in a better result. If you've got losses in 1 year, you might try and bring forward income to try and utilise those losses now. There's also these loss carryback rules which are in place, which I'll talk about in a minute, that you can look at. It's just about looking at your circumstances and making sure that you're taking into consideration not just the current year, but also what the environment looks like for your business in the next year to make sure we're smart about any deductions that we look at bringing forward or deferring income. What we do with our clients is that we do tax projections for a lot of our clients. So we look at tax planning strategies before year end. So we look at their figures up until, say, the end of March or April, and then project out what they look like for the next year, for the remainder of the financial year, to work out what their likely tax is, and then come up with ideas about how you can minimise that tax for the current year. Personal income deductions and offsets. So all these are subject to cash flow. So capital losses. So if you've made some capital losses during the year, or vice versa, you made some capital gains during the year, and you know you've got some shares, for instance, that might have some capital losses on, look at selling those shares to offset the capital gain against the capital loss. So if you know you've done really well on your cryptocurrency this year, but then you've got BHP is not a good example. I'm trying to think of a share that might not, AMP, I'll just pick that one. Sorry, AMP, if no one's listening. And that might have an unrealised capital loss on it. Look at selling those shares before 30 June to offset the gain against the loss, so that you're minimising your tax. Key thing with that, you've got to be very careful. If you sell the AMP shares and then you go back in the market and buy those same AMP shares a few days later, they'll see through that transaction. They'll say that's not a sale because you've just gone back in the market. You're purely crystallising a loss to get a tax benefit, so they'll undo that transaction, right? So it's got to be whereby you sell the share, but you don't go back straight into the market and buy that same share. So just be mindful of that. But yeah, if you've got capital gains on things and you know you've got some shares that aren't performing that well and you think, oh, look, I can maybe divest myself of that one and then look at another investment, then that's an option for you to offset that loss against the capital gain that you may have. And then look at the same thing about between years as well, working out whether, you've got plans next year, retirement, other things that might come into play where your income might be lower next year. And therefore use that as, think about that in the context of strategies in terms of when you sell assets for capital gains tax purposes or otherwise. Also donations, really key thing. You've got to be careful with donations, particularly making large ones, to make sure you do it pick the income year in which they actually will give you a tax benefit. It's good that you're doing donations. We've got some clients where they have decided they're going to make large contributions to particular charities. And we have a chat to them about staggering that over a number of years, so they're not doing in one lump sum in 1 year and creating a loss in their tax return for that year, which they then can't use because donations can't create a loss that you can carry forward. So break them down into smaller pieces each year to make sure that you're getting the tax benefits. If the tax benefit is important to you, to get the tax benefit along the way. You're not going to waste any of that tax benefit. So again, it's just being smart and talking to your accountant, your advisor about that to make sure that you're fully across the different issues that you need to contend with. So just some common strategies, motor vehicle expenses, just a word of warning on motor vehicle. ATO loves looking at motor vehicle expenses. So logbook, who does a logbook? Everyone does, of course. If you're claiming the operating cost method where it's a percentage of, there's a business use percentage, you have to have a logbook. It's got to be no more than 5 years old and it has to be relevant to your circumstances. So if you're claiming motor vehicle deductions, you really should have a logbook to justify the business percentage for the claim. Home office, there's currently a concession because of COVID. We have this, what they call the shortcut method. It basically says that you can get 80 cents per hour that you work from home. So if you're working 3 days a week from home, let's say that's 24 hours per week, 24 hours times 80 cents gives you a deduction of, what does that work out to, roughly $19 something. You can claim $19 per week for each week you're working from home, and that gives you a benefit. That one, there's not much substantiation required on it. They just allow you to do that because it's easy and because the circumstances are laying that up until 30 June 2022. After that, diary records for a period of 6 weeks to justify what it is, and then you can extrapolate that out for the year.
With the 80 cent one as well, I'm pretty sure it means you can't apply for deductions on other things.
Yes, that's correct. That's an all-encompassing deduction. So if you've got a home office or anything, oops, sorry, I pressed the wrong button there. You've got a home office or otherwise, it means you then can't claim any other expenses. It's all-encompassing for everything you do as part of your business activity. But yeah, just again, get more detail on that from your accountant. And uniforms, again, you know, there's laundry expenses and uniform, but again, you've got to be careful with uniform. It's one thing where people think, you know, I've got a logo here, therefore I can claim it. Just got to be careful. There's certain rules around it. And then the occupational specific deductions, union and professional association fees, self-education costs. Again, that you've got to be careful with that one, that it's relevant to your employment, and therefore it's deductible, and a couple other ones there as well. Other tax planning considerations, if you're looking at moving to or from Australia, so if you're migrating to and from Australia, there's tax consequences for that. So assets you hold either in Australia or overseas can be impacted by your residency status. And it's not just a matter of saying, okay, I've left Australia on this day and I'm not coming back for a year, therefore I'm a non-resident. There's all these rules around residency that you need to do these various tests, because you could still be away for 2 or 3 years from Australia, but still be deemed to be an Australian resident for tax purposes, and therefore you're taxed on your worldwide income. So if you're going out and doing a job over in Dubai for 6 months or 12 months, you think, oh, how good is this? I'm getting this tax-free income over in Dubai. No, you're not. If you're coming back in 6 or 12 months, that income is still taxable in Australia. So just to be aware of that. So when there's international border issues, you need to consult with your advisor to make sure that you're fully understanding of what the tax consequences might be if you're either leaving or coming to Australia. Because when you're an Australian resident, you're taxed on income from all sources worldwide. There might be tax credits you get under double tax agreements from other jurisdictions, but if there's no tax in those other jurisdictions, that doesn't mean it's exempt from tax here. They changed rules on that, particularly for the Middle East, where people were going over to the Middle East and working tax-free for a number of years. They changed that about, I've got to be careful about saying, 5 or 6 years ago. Sorry, I've digressed for a sec. I was talking to a client the other day and I said, oh yeah, that rule changed about 3 years ago. I then went and looked at it, it changed in 2008. 14 years ago. Just all these rule changes and just working out this passage of time. So just got to be careful. This one here, now with trust, we're going to talk a little bit more about the trust when we get to the issues that are presently in hand, but with trust in general, there's a couple of things you need to comply with to make sure you meet the requirements for trust distributions and so on at the year end. One of them is that you've got to make sure that you actually you document your distributions to your beneficiaries at or before year end. So you can't do it in July, August, September, October after the year end. You've got to determine how you're going to allocate your profits from your trust to the beneficiaries. If it's a discretionary trust, such as a family trust, you have to do that before year end. And if you don't, then technically the HO can say that that's not a valid distribution, and therefore they tax the trust at 47%. So you just got to be very careful with that. Also, there's some other rules about family trust elections, which I'm not going to go into, but if you've got large franking credits going through a trust, there's also some rules about that, which allows you or precludes you from distributing franked dividends out to beneficiaries. So there's a whole bunch of rules with family trusts, plus the ones we're going to talk about shortly, that you need to factor in when you're dealing with trusts. And that's, again, where you rely on your advisor for that. This one here, be sceptical of tax shelter schemes. My philosophy, This is a common one. If it's too good to be true, it's too good to be true. Right? There's lots of things being around. Oh, you're going to get this wonderful tax deduction here. You're going to save this much tax by doing this or whatever it might be. There's lots of scams that come out generally in the last three months of the financial year saying you can do this, and save tax. Generally, get advice because a lot of those things are dodgy, and they're basically there to line the pockets of the promoter and no one else. So just be careful of any schemes or anything you hear at the pub where, oh, I'm doing this and I'm getting this wonderful tax deduction. It's probably not true. Always talk to your advisor. Other tax planning considerations. So look at things that might be concessionally taxed. Capital gains, for instance, if you hold an asset for greater than 12 months and it's owned in your individual name or through a trust, you get a 50% discount on that. So just factor those things in with your tax planning. So that's some concessions that are available. And then there's also, through salary packages, there's some exempt fringe benefits you can get if you salary package your employer. So if you're an employee, talk to your employer about whether there's any tax planning opportunities in terms of salary packaging that you could do to try and reduce your tax burden. And then using structures that are concessionally taxed, such as trusts, which we'll come to, and superannuation funds, as I said before, accumulation phase 15%, retirement phase 0%. So just a drink. Another really important one, immediate deductions, temporary full expensing extended. So this is where businesses up to 5 billion, so another threshold. I think most people that we know would be caught under that $5 billion threshold. It'd be nice not to be, but so basically, if you buy an asset that's equipment, plant equipment, cars, etc., that's business related, then you can claim an immediate tax deduction for that equipment. That's been extended now to 30 June 2023. It was introduced in the budget 2021, and now they've extended that to 2023. There's some things that are excluded, such as improvements to leasehold or property. So if you're putting a mezzanine floor in your factory or things like that, that's not covered under these immediate deductions. They have to be appreciated over the life of the asset, which could be up to 40 years. So really get some advice about what assets are covered under this, but it is available still, which means that if you buy, for instance, a piece of machinery, for instance, I've got a client at the moment that's looking at buying a business, which has got $3 million worth of plant equipment. Once they do the transaction and buy that, they'll be able to get a $3 million tax deduction for the equipment because it'll be covered under this rule. So there's some real planning opportunities in that respect, but again, don't do things just for a tax deduction because again, you only get back 30 cents on the dollar or 25 cents on the dollar, depending on the size of your business. It applies to second-hand assets as well. So it's not just new assets, it applies to second-hand. So that's really important to understand. Yeah, now also this one, just to throw it on the bottom, there's also these loss carryback rules. So again, if you have a situation where you're claiming deductions and it creates a loss in your business and you paid tax the previous year, you can then actually claw back that loss from the previous year. That's only up until 30 June this year. It hasn't been extended to 2023 because it hasn't passed Parliament. But if you've got a loss and you've paid tax in the previous year, there's a way in which you can claw back that tax for the previous year. There's certain rules around it. Again, it's complicated, but it allows you to be able to get the spread. I suppose use an averaging system of working out what your average income is over the profit is over those years, and then be able to get any excess tax back based on that average. Just another one, COVID relief. This is just one that's current. I thought it'd be good just to make people aware of it. If you're a landlord and you've given relief to your tenants over the last little while, from the 28th of July 2021 until the 15th of January, you've got the ability to get some land tax relief, but you need to apply by the end of this month, so 30th of April, and there's a link there. So if you've given land tax relief, again, there's certain criteria. Your turnover must be less than 50 million in order to qualify, but that's certainly something that's available. We all know land tax is quite a big cost for landlords, but they're giving some relief on that. So if that applies to you, definitely look into it further. Again, we can assist with that if need be. Super changes. So key ones here. So first of all, there's concessional contribution cap limit. So to get a tax deduction from super, you can contribute up to 27,500. So that's from the employer and also you personally. You contribute up to 27,500 into super and get a tax deduction against your marginal tax rate. Or the business will get a tax deduction for it as well. And that is taxed at 15% in the fund, subject to that Division 293 tax I talked about before if your income is over 250,000. Also, they've increased the non-concessional cap to 110,000. It used to be 100,000, now it's 110. That means you can make a lump sum contribution to super, not claim a tax deduction for it, but you can put 110,000 into the fund, and that gets more money into the super fund environment, which is concessionally taxed. From 1 July 2022, so this is a new rule, you can now do that up to the age of 75. They changed it last year to be 67. They've now extended that now so that you qualify to do that up to the age of 75 without a work test being satisfied. So that's really important for non-concessional contributions. If you want to claim a personal super contribution deduction though, so where you want to claim under that 27 by you making a personal contribution, you will need to still satisfy a work test. It's only for the non-concessional that you don't, or if it's employer paid contributions that you don't, because you already satisfied the work test because it's employer paid. There's also a bring forward rule. So again, this is being extended now. Instead of being 67, it's now 75, where you can make 3 years in one go. So you can bring forward, and it all comes down to your superannuation balance. And I'm not going to go into that part of it, but in effect, you can do up to 330,000 as a lump sum into super, non-concessionally, and that gets more money to super, provided you are not in pension phase and provided your balance is not greater than 1.48 million. There's all these rules on it. But that's a good opportunity. And secondly, what you could do as a bit of tax planning, you could do 110 before 30 June, and then on the 1st or 2nd of July, you can put 330 in, so you can get 440,000 in per person within a very short time frame. In addition to that, there's also I'm not going through it today, but there's a downsizer provision where you can put another 300,000 in as well on top of that if you're downsizing your family home. There's certain rules about that. For the age over 60, hold the property for more than 10 years. You can also make a lump sum contribution from the sale of a house. Now, they call it downsizer, but you don't actually have to downsize. You just have to sell the property to qualify. So you can sell a house for $2 million and go and buy a $10 million property, you'll still qualify. Term, I don't understand why they call it downsizer, maybe because of marketing it sounds better. But there's some important super changes. Also, there's also this one, which is for unused concessional contributions. So there's this, what they call a catch-up or a catch-up carry forward provision. So just give an example. This is what we get from the HL, and you can get through your MyGov account. So that 27,500 you can contribute per year. It was 25, it's now 27,500 that you can have as a concessional contribution, which means it's tax deductible to the person paying it, and it's taxable in the fund. You can bring forward, if you haven't met your contributions, if you've got a member balance less than 500,000 and you haven't fully utilised the caps in the previous years, they allow you to catch up those contributions. So in this example, one of our clients, this is for the 2021 financial year because I don't have data for 2022 yet, but there was 50,000 over the last 2 years because this came in 2 years ago. There was 50,000 worth of contributions that this client could have made over those 2 years. They only made 34,000. So they can make an additional 10,000 on top of the 27,500 they might make this year. So that means instead of making 27,500 this year, they could go up to $38,000 or $37,684. So they can catch up those additional contributions. And that applies each year for up to a period of 5 years. So we're 3 years into this program, and then in 2 years' time, there'll be 5 years. So if in 5 years' time you haven't made any contributions into super, you'll have 25 times 3 plus 2 times, maybe got that wrong, 25 times 2 plus then 3 times 27.5. You can make contributions of 125,000 to super and get a tax deduction for that as a catch-up contribution. Now, you've got to have the cash. That's the catch. So, if you've got a member balance less than 500, you may not have that cash readily available. But what it also allows you to do is do salary sacrifice to be able to catch up as well. So if you can do it through your wage, if you're on a higher tax bracket, say 34.5% tax bracket, including Medicare, every dollar you put into super, you're saving 19.5% tax by putting into super. So when you're getting closer to retirement, this might be a worthwhile strategy to build up your superannuation quickly. And that's what the motivation for having this legislation in place is for. Right? So that's something you can look at. Transfer balance cap. So what this one is this is really important for contributions. So once you get above, so transfer balance cap came in 2 years ago, or 2 years ago, and then they changed the rate from 1 July 2021 to 1.7. What it means is once you exceed a $1.7 million balance in your superannuation fund personally, it restricts what non-concessional contributions you can make into the fund. It actually stops you making non-concessional contributions into the fund. What they're trying to do is they're trying to stop people using superannuation as a low tax environment to build up their wealth, because they think 1.7, the commentary really is around this is 1.7 is enough for each person, and therefore anything above that you've got to pay. They want to restrict you. So you keep that outside of super and therefore invest it outside of super, and then they get a higher tax return on that, the earnings from that money. So really important balance. So is really important in part of planning when you're looking at making lump sum contributions into super. So just making you aware of that. And this one's really important. So for employers particular, but both employers and employees. So the superannuation guarantee charge, so the 10% goes up to 10.5% on 1 July 2022. So that's an extra cost of business that people need to factor in. And then that's what the plans are for the next 3 years to eventually get up to 12% from 1 July 2025. So just got to understand that this is another cost to business you need to factor in. It's about whether you have to pass that on to employees or whether they can absorb it. So this is a challenge for businesses to work out with their employees about how they're going to deal with this. So it's really important to look at your contracts too, to see whether your contract is plus super or inclusive of super, and about whether you've got some flexibility in that. Obviously, you want to do the right thing by employees as well. So it's about having that conversation with them or working out what your plan is. But definitely doesn't seem like much, but even 0.5% is, you know, if you've got a large payroll, that can be quite substantial. And then, as I said, it's going up by, in effect, 2% over the next 4 years. So something to factor in. As I said before, with single touch payroll, the ATO is also aware if you're paying that on time or not. So again, it's an exposure that you need to contend with. Now, to finish off, these proposed trust changes. So this is applying to family trust primarily, or discretion. We call discretionary trust, but that another name for those is family trust. So the ATO released a draft ruling a few weeks ago where they basically put their position in writing of how they deem certain distributions that occur from the trust. And it's all to do with this wonderful section 100A. It's been around for a long time, and the interpretation of it has been very ambiguous, when you put it that way. And so the ATO has put down their position on paper, and at the moment, I'll go into the detail about what it all means, but there's a consultation process at the moment. So this is a draft ruling, so it doesn't apply. So the ATO's position doesn't technically apply at the moment because it's draft. We've got a consultation process open until the 8th of April 2022. There's lots of submissions happening from the relevant accounting bodies and other parties, because what the outcome of their draft ruling will be if they finalise it is quite significant for trusts going forward. I'm not going to go into the technicalities. I'm going to summarise it very briefly. So what they're basically saying is that if you've got a trust, at the moment, normal practice has been, or common practice, not normal, common practice has been that if you've got family with party, so a family trust can encompass you, your spouse, plus your children and other family members potentially. And what they're saying is that when a child reaches 18, when they become an adult for tax purposes, what has been commonplace is that you would give a distribution to that child, and that will give you the benefits of reducing your tax liability because they might have no other income. So it's a way of channeling or transferring profits to a child or a low-income beneficiary to reduce the tax rate. What the ATO is saying is their position is now that if you do that, the money has to flow to that beneficiary. So if you've got a child who's 18, just turned 18, and they've got no income, if you decide to give them a $50,000 distribution of profit, then that $50,000 has to be paid within a reasonable time frame after the year end. Now, what does reasonable time frame mean? It doesn't mean 3, 4, 5, 6, 7 years. It means, my understanding, it means fairly quickly, so within 6 to 12 months. 12 months is probably stretching it. So the money physically has to go to that person. They have to receive that money and they have to keep it. They can't give it back to you. Because if they give it back to you, it's deemed to be a Part 4A or a tax avoidance strategy, and therefore that distribution will be deemed to be invalid, and the trust will pay tax at 47% on that distribution. Right. So this is what they're saying. Their position is that that is the situation. Similarly, if you have a beneficiary company of your trust, so let's say that you've got the trust, it's got a big profit for the year, and you want to allocate $50,000 to a company to limit the tax rate at 30%. If you make that book entry to the trust, to the company, then the tax is 30% on that distribution. If the cash doesn't flow to the company, that is deemed to be a loan from the trust to you personally, and that is called under what we call Division 7A of the Tax Act, which means that has to be repaid within 7 years. And there's interest on that loan and all these other situations. At the moment, if you distribute profits to a company, it's called an unpaid present entitlement. You've got 7 years to deal with it, but you don't have to make repayments per year. You have to charge interest, but you don't have to make repayments per year. Under the new rules, they're saying that's a Division 7A loan. You have to make minimum repayments against that loan per year to clear it within 7 years. So it requires a cash flow. So what they're basically saying is that if you have a trust, the cash has to go where you're nominating it to go. You can't be nominated to go there and then go in your pocket. they're saying that's not a valid distribution. Yes, Peter.
Shane, what if the 18-year-old beneficiary has got a debit account?
Doesn't cut it.
Can you repeat the question?
Okay, so Peter's question was, what if that adult beneficiary's got a debit loan account? My question is, how do they get that debit loan account to start with? That would have been through family paying things on their behalf. Those maintenance costs while they're a child are not deemed to be a debit loan account, which therefore the distribution then credits that loan account. Yeah, so that doesn't work. Yeah, they've given a number of examples in the draft ruling. That's one of them. Another one is where money goes to the child or the adult beneficiary, and then it gets given back to the parents. They've given a whole raft of examples about where they believe these are not valid distributions. So it's a really important, it has really important implications for clients that run family trusts, because it basically changes the scope of what we can do from a distribution point of view. The key thing is, I want to stress at the moment, it's only draft. It's only a draft position from the ATO, but subject to what lobbying and traction we get on it, there will be some changes, I think, which will be detrimental. We just need to plan for those. We just can't plan for them at the moment because it's only draft. The other thing which is a sting in the tail with this too is that ATO has said that they can go retrospective to 2014 on this. So they're saying they've had this position since 2014, and therefore they can then go retrospective for the last 7 years. That's my commentary on that. That is completely unreasonable. Because of the fact that it's taken them 7 years, they've started looking at this back in 2014, and now they've said that this is our position, and they're going to retrospective from when they first considered it. There has been, I read some articles on the weekend, both Liberal and Labor have said that they will aware of that complication about the retrospective nature of it, and they will address that in some way. So there's hope that they won't be able to go back retrospectively. Then the issue is, because this is draft, we've got elections coming up, the timing when this might turn to be final, when will it apply from? Will it apply from when they then release the draft legislation, therefore it captures the 2022 financial year? Or is it from 1 July 2022, therefore we've got one last year of flexibility or status quo before we then need to redress how we deal with these scenarios. So it's a really significant change, and in the accounting, and this is that one about Division 7 I was talking about before, I'm not going to go into that in more detail. It's a really significant change, and yeah, it requires a bit of planning. Once we've got some more certainty about it and where it's heading, it requires us to sit down with our clients and actually talk to them about it and look at the implications. Only applies to adult beneficiaries. So husband and wife, not an issue. It's only for your children who are adult beneficiaries that it could be an issue, or a beneficiary company that you use to cap the tax rate, it'd be an issue for them. For minors, it's not a problem because the maximum you can distribute to a minor is $416 anyway. So the ATO is not worried about that. It's not material. It's only when they become an adult. But yeah, any previous debit loan accounts are not relevant to the assessment of how it works. So yeah, it's a challenge. There's lots of family trusts out there. Hopefully the lobbying will mean that there's some relief from what they're proposing, or there's some grandfathering or some sort of transition phase whereby it gives us enough time to plan for it and deal with it appropriately. So that is that. And I've just gone through all that, and I said the retrospective nature. So it's just really important that we are across it. It might require a review of trustees and so on down the track to make sure they're worded correctly, etc. But all I've said to people at the moment is we'll let you know as soon as we know more. At this moment, we're in a holding pattern waiting to see what the outcome of the consultation process is, and then what the ATO's response is, and the timing of all that. So we've got to make some decisions before 30 June about this year, but we're not at the point of where we're comfortable to do that as yet. So it's unfortunately just makes it a bit hard to do some tax planning for this year for our clients. Lastly, Fringe Benefits Tax. So just to go through that, dreaded tax, if you can avoid Fringe Benefits Tax, please do so, because the way it works is that the tax rate is 47%. And it's not just 47%. The way it works is that if I provide Chelsea with a fringe benefit for $1,000 that's subject to Fringe Benefits Tax, I've got to gross it up by a multiple of 2. So it becomes $2,000. And then I pay tax at 47% on the $2,000. So it's a 94% effective tax rate. You do get a tax deduction for it. So very generous, they give you a tax deduction for the FBT, but the effective tax rate on FBT is extremely high. So it's really important that you consider the FBT consequences. We've just sent out a whole bunch of information to our clients who register for FBT, for them to make sure they do the appropriate declarations and so on. That's really important. Key items though, there's been some relief this year because of COVID. So it's really important to be aware of those. So as we talked about rat tests, rapid antigen tests, we probably should put a test in, but yes, rats, protective equipment, so masks, protective shields, etc. They're exempt from FBT at the moment, which is good. They've also changed the car parking rules. That's going forward, but they've actually, because of COVID and a lot of people were in lockdown, they've actually, for FBT for this year, we can actually remove the days of lockdown from the calculations of the FBT for our clients. So I think we did a session on this a few weeks ago, and I think during the 2021 year, it might have been 95 days of lockdown in Melbourne. So therefore, when we're calculating the FBT up until 31 March, we don't have to calculate it for the full 365 days. We only calculate it for that minus 95 days. So it reduces the FBT consequence. So it's being aware of those things as well to reduce the FBT. And then one of the key things just for that used to be that if you do salary sacrifice, that will remove the obligation to pay superannuation guarantee on that salary sacrifice component. That's gone now. So that's just a minor one that was in there. And as I said before, make sure you've got a logbook for your vehicles. The HO will start checking that more actively. People are very loose on the logbook, but if you're claiming large motor vehicle deductions, the logbook is critical. The other thing too is be clever. Make sure that it ties in with your activities, such as repair receipts, where they put the odometer readings on your repair receipts and things like that. Just make sure you're doing it properly and not try to do it retrospective rather than where you might get caught out for putting wrong information through. So that's that one. Just the last one. This is one we're trying to hammer this home for people. ASIC has got a new system about director IDs. So if you're a director of a company now, you have to get a director's ID, which is your personal number, like a tax file number, but a personal number for you to be a director of a company. You have to have an ID. And they've got this phase-in program, which they've started. And we've got through phase 1 here. The way it works is that anyone who is an existing director of a company on or before 31st of October has got until 30 November 2022 to get their director's ID. Now, if you don't, there's just a little fine if you don't get it, all right? So just a little one. So yeah, leave it to the last minute, you'll be fine. No, get it done straight away, because that's what the fine is if you don't do it, potentially. All right. Now, I'll give you the reason why they're doing this, but the first thing is that, yeah, if you're already a director, you've got to do that. However, if you are setting up a new company for any reason, as of yesterday, was it, or 4th, Monday, you cannot now get a new company without having director ID. So even though you've got this transition phase to 30 November with existing director, if you're an existing director but you want to set up a new company, you need the director ID before you can set up a new company. You need that now. So we had a situation today with a client. They had to go and get their director ID before we could set up a new company for them. So it's really important that you look at that. Whereas before the 5th of April, you could do it, you had 28 days from the date of appointment to do it. So it's really important you get your director IDs. Now, we've got a link here, which you'll get in the slides for how you go about it. We've got some detailed examples, but you need a MyGov ID. This is not a MyGov account. This is different. It's a MyGov ID. It's different to a MyGov account. And you need to register for a MyGov ID. Yes, I know. In order to get your director ID. Once you've got a MyGov ID, it is about a 5-minute process to actually register. To get the MyGov ID, could take quite a long time because you've got to show proof of identity and all these other things to be able to then satisfy the requirements to get the MyGov ID. Now, why are they doing this? 2 reasons they're doing it. One is that this is to stop fraud. So up until these rules came in, if I wanted to set up a new company, I could say, okay, I'm going to set up XYZ Proprietary Limited. And then when it asked me to put my director and shareholder details in, I could just call myself Fred Nurk, make up a date of birth, make up an address, hit the button. Within an hour, I'd have a new company with Fred Nurk as director. So I can then go off, trot off to somewhere and basically purport to have a company. I'll go and get an ABN, get all that stuff and start trading under a false name. So, you can't do that once you have your director's ID, because you need to use the ID when you set up the company, and it requires all these identity checks before you can get that director's ID. So they're stopping that. The other part of this, why they're doing it, is because at the moment, if I want to do a company search on Mike, your company as an example, I can do a company search. I can get your details, full name, date of birth, and residential address by doing company search on your company or a search on you. So it gives lots of information under privacy. So under this scenario, when they do a company search, it'll just show your name plus your director's ID. It won't give you date of birth. It won't give your address. So it'd be more anonymous per se. So less transparency in terms of that data. So again, to stop fraud. There's a catch with that. We're going to have this done director's ID. I'm talking about director's ID here by 30th of November. There's nothing talking about shareholding. So if you're a shareholder of the company, this will come up with your name and your address. It won't come up with your date of birth. It'll come up with your name and address. They haven't dealt with shareholders yet. So if you're a shareholder, you'll still come up with more detail than what you were in the director's ID. So that'll have to come at some point, but they've made no noise about that. This system also, the date that they're saying you have to get this done by is the 30th of November 2022. The actual system won't go live for another 12 months after that. So 2023. So at the moment, I've got a director's ID. You log into the website where I can see my director ID. If you want to see what companies I've got, it says pending or it says not available yet. So it actually won't show all your details. Once it's all up and running, so in 2023, it also allows you to go in and update your details within your portal. So update your address or whatever else on there, and that'll then update automatically all the companies you're a director of. So there's some simplification will come with it as well. So again, to make your life easier. I'm sorry, I'm being cynical on that. I probably didn't have the cynical voice on enough, but again, it's more information the government will have on for each person. But again, there is valid reasons for it. Stop phoenixing, stop fraudulent activity in terms of setting up companies and so on. So if you haven't done it yet and you're a director of a company, get onto it because you don't want to be facing those sort of fines. Because I said there's going to be a lot of people doing a mad rush in October or November. Don't be that person. If you've got a spare, Easter, sorry, I'm taking away your holidays. Easter might be a good time to have a go at registering. Once you do register, it's good to let your accountant know because for us, as if you're a client of ours, we need to have that on our database so that we can then interact on your behalf for asset purposes in the future. So once you do get your ID, it's really important for you to advise your accountant that you've got it and then what that number is.
There's a step-by-step instructions on that link that's included.
Yep.
So we've broken down how to get the MyGov ID and then from there, how to get your director ID. So it's all there for you.
Yes. So good luck and have fun with it. If there's a slight discrepancy in your name, like I had an issue with mine because I had a space McKenna in my license. It's got a space between the C and the K, and on my passport it doesn't. And that was an issue. But yeah, so there, and also if you're married, so change your maiden name to your married name. That can create some complications as well. Yeah, if you get stuck, if you're a client of ours, Chantel, I'm going to throw her under the bus now. Chantel from our office is really good at helping you through any issues if you get stuck, because she does this for a lot of our clients and is managing that process for us internally. So, yes.
However, we can't apply on your behalf.
No.
We can assist,
Yeah.
but we can't apply on your behalf.
Yeah, under privacy rules, we actually can't create a MyGov account or MyGov ID for you. We're not allowed to. So, yeah, so you have to do it yourself, but we can assist if you get stuck. Yeah, right. That's it. Any questions?
Anyone on the chat, if you have any questions, just type them in the Teams chat and I'll ask on your behalf.
I've got a silly question, Shane.
Mm-hmm.
Just with the family trust, whether if they go retrospectively backwards, 2014, there'll be a few young adult children of these people asking for 100 grand in their bank accounts.
If they've got an accountant advisor,
If they're
yes.
studying tax or something.
Yeah. Look, there's risk with all this. The other thing with it, the key thing with this, the retrospectivity, the HO said they won't apply retrospectively, but you don't know. So I think it's going to be best if there is a response from the government in some way to basically confirm that, so it removes any uncertainty, because they say they won't, but if they then find another issue for another tax matter, then why would they not then go and look at that as well as part of their review? So the key thing is appropriate documentation and everything, and if there's if we need that comfort that there's not going to be retrospective, because there'll be a few people exposed we're using family trusts. Yep. Because this has been the common way of doing things. And now to have that position changed, and then to say that they can go back for 7 years, I think is unreasonable. But let's wait and see. Yep. Any other questions? Oh, yeah, Mike?
COVID grants, there were a whole swag of them over the last couple of years. Do you think there are a whole lot still kicking around or not?
No, there's not. No, in terms of COVID grants, what are kicking around just for the people remotely. There's one at the moment which is about ventilation. We can get up to $500 if you invest in ventilation for your business.
Yeah.
You can get a reimbursement of $500. So that's the only one that's out there at the moment. Oh, there's some apprenticeship programs that are out there too. But in terms of those Victorian government grants, etc., no, they've run their course at the moment. Yeah, it's just that land tax relief one that I talked about for landlords. This ventilation program one. I'm not sure what's out there in other states at the moment. I can't tell you that. But for Victoria, there ain't much there anymore. Yeah.
There's no questions online, so we might jump off the online portion of the seminar. But thank you to everyone for tuning in. And we will send you the recording and the slides tomorrow. But thanks very much for joining us.
Thank you.